Now, psychology is one of the most overlooked, but one of the most important parts of trading, CFDs or short term trading. Because if you were going to buy X, Y, and Z stock, and you were going to buy it for real money and put it away for your grandchildren, you only want to care that you're buying X, Y, and Z, and over the next few years, it's going to go up in value. You don't care that X, Y, and Z dipped down for the last 10 minutes and it's going to go right back up to where it was trading at a short while ago. But short-term trading, we don't really care to any great degree what an asset is truly worth. We only are concerned with where it is at the moment and where it might go in the next few moments. And we want to talk about high probability trading. Because remember, we're not talking about investing. We're not talking about swing trading. We're holding things on for months to regain its natural or what its value should be. Now, there are techniques that will help you get a solid edge in the market. An edge is simply a statistical significant trade expectancy that will be, when applied over a series of trades, will yield you positive results. Some traders find an edge through technical analysis, while others try it through fundamental analysis. Additionally, there are groups of traders known as high-frequency traders that rely on speed of execution as their primary edge. Each trader must evaluate their own personal skill set and find their own trading edge if they are to achieve long-term success in the markets. Now, as a matter of interest, there are two primary types of trading styles that are most often applied. The first is the trend following approach, and the second is the contrarian approach. Trend following or trend trading methodology focuses on finding high probability trade setups that are aligned in the direction of the larger trend. Now, I'm going to diverge here a little bit, and we're going to talk about why psychology is important. Now, I'm a crime television show nutcase. You know, give me Criminal Minds and I'm thrilled to death. I don't know why. But we know when we watch these things like, you know, that have the BAU, the Behavioral Analysis Unit, they're using psychology. What is it? High probability guesswork based on how often things have happened in the past or evaluating behaviors from the past. Now, when you talk about these serial killers, most of them, when they're talking, I listen to them and say, I could have guessed that much. Oh, she must have been somebody he was emotionally involved with. You know, oh, he must think it's his mother or taking out something on his mother. Or, you know, all the other choices. They are looking at things that have probably happened or has happened before and applying that information to what's currently happening in the present. Now, when we talk about trading with the trend, okay, what we're talking about is understanding the psychology of the markets at the moment. Now, a trend is when price is moving upward. A trend doesn't have necessarily a set of rules. Trend just means the price is generally moving up. Just like we know inflation's moving up. Okay. We know the price of groceries are climbing up. So what are they doing? They're trending upward. We can come up with all types of explanations, all types of economic and statistical reasons for this to be happening. But the fact is, when you go to the grocery store, you know butter's more expensive today than it was yesterday, and then it was a week ago, and then it was a month ago. And this is a trend. Now, the fact is, whether we're a trader or we're a politician or we're an economist, even the central banks raising interest rates can't stop this trend. They can try to slow it. They can try to capture, they can try, because like a central bank, forget about trading, but a central bank, when they're raising interest rate, they're not trying to stop inflation from raising today. They're concerned with down the road. An economist who's lecturing on how we can stop, nobody can stop what's happening. The cycle has already started. Now, when prices are trending upward, we can apply our psychological understanding and understand how this trend is working. Because what happens is, just like with inflation, prices start moving up. Nobody knows exactly why or exactly when that first thing started that made this happen. Because lots of times we have prices jump and they go back. You have fuel prices jump and you'll say, we're going to have inflation. And fuel prices drop back down and everything goes back to normal. And then we have times that other things happen. Now, when we start seeing a trend in an asset, it starts moving like that. We don't see it. We don't notice it. We're retail traders. We're the little guys. Some big bank, some big investment house saw that the euro was starting to climb, and what they went in and made a trade for several $1 million worth of the euro. Now, they set their trade. They entered here. They set their exit point. They set everything, and they're gone from the market with their profit before you and I ever realize it. But what happens is, as that asset starts moving upward, others start realizing it, and they start jumping in this marketplace. This marketplace starts to gather momentum. As that momentum gathers, it's very hard to stop it. Once it's moving and we see it moving up, there's a point which that initial trader set his sell point, because that's all the profit he wanted to take, and the price starts easing back down because it's got to sell off all that he wanted to sell off. But then the rest of the buyers start jumping in the market and they start pushing price back upward. Well, at that point, the asset or the market has gained momentum. Now, why it has, we don't know. But we can understand the psychology of what is happening now. We can explain the behavior of the markets. Because if you stop to think, the markets are mostly random. They spend most of their time in messy situations. The only time the markets become, hold on a second. Uh-oh. The only time the markets become non-random is when they start exhibiting trends. Now, whether we're talking about an uptrend or downtrend, it doesn't make a difference. So then a natural question arises. Should I focus on a trend trading model or a means reversion model? The answer to that question isn't always clear-cut. The reason being, there will be certain market conditions that favor a trend following approach and other market conditions that favor a mean reversion methodology. It is our job as traders to evaluate the current market regime to decipher which model would provide the highest probability trading application at a specific time. Now, keep in mind that the market is made of millions and millions of people, not computers, but human beings making independent decisions and making decisions for all kinds of reasons. And for this reason alone, it's really hard to decipher the markets. But once you can establish that and understand what's going on in the markets or the psychology of the markets, you can then make some significant trading decisions. When you see a trade starting to establish, imagine as a kid, didn't you ever have a hamster in a cage and it would land on that wheel and start puffing and puffing and start the wheel turn? But once it would get that wheel turning, it could go forever and you'd be amazed at how fast it would have that wheel turning around. Well, that's what happens with the markets. They gain momentum. But we also have to understand where we are in that frame of that momentum. Because like I said, what starts this movement, what jumps that hamster on that wheel, and when he starts making those first few rounds, isn't you and I. We don't notice it. We're still in bed sleeping. We get up when we hear that wheel turning and take a look over and say, that crazy pet of mine is just driving me crazy. But imagine there's an investment banker, a trader at an investment bank. He trades, say, the euro US dollar. Now, he had done all his evaluation. He heads into work at 4 o'clock in the morning. He's going to start making his trades because he's waiting for the Japanese markets to close. And he's decided he's going to spend a couple $100 million this morning and buy the euro because it's going to go up. Of course, he can't do it from his cell phone. He can't even do it from his laptop. He can only do it from a high security computer in his office. But he's going to go to work as opposed to and make his trade. Except he leaves his house and gets out to the car and he's got a flat tire. He fixes the flat. Now he's in a bad mood. He's also 20 minutes late. Now he hits rush hour traffic because he's too late for morning traffic. He missed his morning gap. And traffic takes forever. He arrives at his office an hour and a half late. He gets up to his office and he's just in a bad mood at the moment. And he's now decided he can't make that trade because guess what? He missed his entry time when he would have made that trade. He's got to go back and reevaluate everything. Okay. His flat tire had a whole effect on the value of the euro US dollar. Even though it's a couple $100 million trade, the markets are too big for one person to affect it. But that one trade might have sparked 3 other people to jump in and start trading. Might have sparked 10 people, could have started a run. We don't know because it's made up of human beings doing human things. Now, the market is basically in constant change, and each moment offers potentials for new setups. Many of these moments, however, do not provide an edge to the trader. And see, for us, we are only looking for that psychological edge. Because I don't care whether the euro is worth 107. I don't care if gold is worth $2,000. I only care that gold is trading at 1982, and I think it's going to go later today back to 1986, where it was last night. I don't care that it's worth $2 because I'm not going to be in the market to. I'm only looking for that little edge to get that little fast trade. And I need a high probability setup to make that decision. Now, setups with high probability for success have a certain scarcity. They just don't jump out. They're not everywhere. They're not all the time. The Forex trader must wait patiently for these setups to occur, like a tiger waiting for its prey, and then execute with discipline when the moment arrives. But how does a trader recognize the moment of waiting and executing? This is when the introducing of concepts of decision spots and triggers are crucial. Now, even though we're using market psychology, we're understanding what the markets are doing. We don't just blindly make these trades. We don't just jump in with emotion and say, oh, look at that. There's an opportunity. I'm going to make that trade. So you need to have lines in the sand. You need to apply in your rules how you're going to do with this psychology. How do you find a trade setup? So we have decision spots are important and key levels of the time frame of your choice. Identifying decision spots allow a trader to ignore price action in the middle of nowhere and wait for the price to reach the line in the sand. This is critical because setups in the middle tend to be lower probability and setups at key levels are higher quality. We, you and I, retail traders, should never be making a trade that isn't the highest quality with the best setup possible. And this is one of the biggest problems that we as retail traders, we can't walk away. We can't say this trade isn't a high probability trade. You get wrapped up in your trade, and before you know it, you made it. Even though you might have made a couple dollars, you lost out on some other high probability trade that could have been happening anywhere. So using high probability Forex trading strategies has enormous advantages for trading psychology. First, it does not cost a trader any money. It doesn't cost you anything to watch the markets and look for trade setups. Most importantly, traders don't have to worry about missing a setup, chasing a setup, entering a setup too soon. It is an enormous help for remaining patient and keeping the discipline needed in trading. Plus, traders can avoid revenge trading by keeping a cool mindset. Taking too many doubtful trades can easily lead to overtrading, which leads to the slippery slope where a trader wants to earn back their money quickly. So what you want to wait for is an action, a trigger. You need to have something that kicks you in the back of the head and say, okay, it's time to make that trade. So how do I find a trade setup? A trigger is a signal of interest that traders waiting for. Their trader has been patiently waiting for the price to move to one of their decision spots. And now the price has reached it. Now what? Okay. Now, let me pop up a live chart and ask you what you guys would have done. Now, look at this chart. Okay. This is for the S&P 500. It's nothing that you all should have been trading, nothing you should have been watching. But if we were watching this asset, and remember, we can only trade moving forward here at the window. But if we were watching this asset back here and we got a triangle, another triangle, we actually had a break below. But then we saw the price return into that triangle, go past the triangle, break out, and start moving up. What did we start to see here? We started to seeing the building of momentum. Okay. It broke its resistance. It turned its track. It now has gone higher than its previous highs. And we start seeing an opportunity, a high probability opportunity. Because once we start this, the momentum and the market movement can't be stopped, or can't be stopped in a short period of time. Sure, the market could fall down here, but if we could have gotten in here and traded to here, we would have taken our nice little hunk of profit and been out with a high probability trade. But how would we have seen it? How would we have captured it? Okay. And that is a question we all want to answer. And that is looking for triggers. So how and when to trade. This is what the trigger solves. It basically is called as a call for acting. The trigger provides confirmation on how to trade at the decision level. It provides clues whether a trader will go long or short, or in other words, whether they would take the break or the bounce. Each trader can choose their own indicators, tools, patterns, trends, and support and resistance for the role of decision spots and triggers. There is no right or wrong method. You should pick something which you like to use and that matches your trading plan and your psychology. Now, if you notice what I just showed you, I'm the king of triangles. Triangles and support and resistance and trend lines make my entire trading strategy. But you need to have what we call decision spots, advert, and triggers. For triggers, my number one tool is candlestick and candlestick patterns. Runner-ups are fractals and trend lines. When you get say a doji forming directly on a line of support and resistance, you have a total indecision in the marketplace. It can be a trigger if you have a trade set up and a trading strategy for trading that type of setup. Okay. You could use a confluence of support and a bullish bounce or even a bearish bounce to set up your triggers. You can set up using Fibonacci rules. But the best opportunities are called sweet spots and areas where the strong confluence of levels exist and wide open space is present. Confluence zones are the best decision spots available because it increases the probability of a trade setup succeeding. In other words, if you have a trade set up, say for a buy, and your next level of resistance is far enough up that you have a lot of white space on your chart, that means you have a lot of potential upside. Wide open space is the potential movement price can make after reaching the confluence zone upon breaking out a break or a bounce after hitting another decision spot. Other sweet spots can be identified by using concepts of impulse and corrections. Price is always in either of the two, and it depends on the strategy which you prefer. If price action trading is a study of price movements, price action trend trading is a study of trends. Traders can make use of several trading techniques to spot and follow price action trends, such as head and shoulders for trade reversal. But ultimately, it comes from understanding what the market is telling you it's doing. What are the traders telling you they are doing? Not what price to enter the market, not what price to exit the market. What price or where, what do I want to enter? You know, somebody once explained to me, when you're sitting and watching an asset move, you're basically sitting on the sidelines. You're sitting there watching your favorite football team and you're hollering at the players, you're hollering at the refs, you're hollering at everybody. But you don't care. You're making your opinions known, you're hollering, you're enjoying yourself because you have no risk. You're just a guy sitting in the bleachers. But the minute you get called and step on the field as a player, what do you take on? You take on a huge amount of risk. You could break your leg. You can kick the ball in the wrong direction. You score a goal for the opponent team. You can be part of the losing team. Okay, you've taken on risk. The only success in the market comes from when you close the trade. Just like when the game's over. It doesn't matter. All those little things happen in between if you end up the winning team. All the other things are long forgotten because you made profit. But you don't want to be on the losing team. So you've moved from sitting on the sidelines to taking on risk. But the only time you can make profit is when that last second goes off that clock, when you close that trade. So understanding what the market is thinking, what the traders are thinking, what is happening in the market is much more important than what price do I enter the market, what price do I exit the market. Okay. Ultimately, you need to put a entry point, an exit point, a stop loss point. But first, it's understanding what the market is trying to tell you, who the players are, where they are, who's sitting on the sidelines, and who's out on the field. So understanding the psychology of the markets becomes the most valuable tool you can find for finding high probability trades. Understanding sweet spots and triggers can be ultimately important because it gives you a set of rules to go by as opposed to trading emotionally. So thank you very much for joining us. Have a great trading week, and I hope I gave you a little bit to think about tonight. Good night now.